Hey, everybody. Welcome again to another Everyday Trader. This is Greg, CEO of OptionsANIMal. Good to be with you again today after
And what?
after an interesting day in the markets.
They're all
I use that
interesting.
word again. Interesting.
You say that every day, and I know you sincerely mean it. It's
I do.
true. There are some, but there are some days that are more interesting than others. Yesterday being particularly interesting. This is Eric Hale. And before Greg says it, just like and subscribe and comments and feedback is very helpful. So please leave feedback. It helps us with our Google algorithm. Appreciate all you do. And yeah,
Well, we
it's
got
good to
through
see a
our.
bunch of you in Irvine
Oh,
last week.
yeah. We haven't done one of these since Irvine. So, yes, good to see many of you in California last weekend. The weather was beautiful. I'm back, piles of snow out my front window.
The
But
weather is beautiful. You walked from the airport literally across the street to a hotel and back.
I actually did go outside for a while during lunch. I got about 30 minutes of the 75-degree weather. So,
Okay, there you go. The
well,
hotel's literally across the street from the airport, like right across the
yeah.
street.
So,
Well, hopefully in Orlando, we'll be driving. We're going to be in Orlando in April. For those of you that are interested, it's a one-day event, so generally local. So those of you that want to get on a plane and come and see us, we're planning something probably a 2-day event. And those, if you're going to get on a plane and come, save it for the 2-day event, which will be in June sometime. Yeah, we're honing in on Austin area. We've done Dallas, we've done Houston. I know there's fans in both, but this will allow people to come from both, hopefully. So drive on over if you're in those regions and spend the night. We'll get the date out to you soon. So, and no cost for OptionsANIMal members to attend this. So you need to, and Trader Oasis as well. So we need you to get you there.
So we got through our meeting, we got through the Fed announcement, and obviously had a big sell-off yesterday right after the presser when some of the comments came out from Fed Chair Powell about their view on interest rates. Of course, the announcement was raised by 25 basis points. I think that was pretty widely expected. I wouldn't have been surprised to see 50, but I think 25 is okay. They made a couple changes. I think this is a really good tweet, by the way, with Nick Timrose put out yesterday about some of the edits and the changes that happened in the Fed statement. And some of the key things are, looking that job gains have picked up in recent months and are running at a robust pace. So jobs are increasing, they're speeding up.
So pause. Is that dovish or hawkish?
I would say that's definitely hawkish.
Hawkish, exactly. Okay, well,
hawkish.
Go on.
The next one, instead of inflation has eased somewhat but remains elevated, it's just inflation remains elevated. That's also hawkish.
Yeah, they didn't take the eased, so they took ease. That's hawkish. So I don't because the initial reaction to this press release was bullish. I think the commentators I heard yesterday said that Chair Powell made a dovish statement, and I'm like, did you actually read the statement? Because that's not what he said. This is hawkish. This is saying that we're probably going to raise rates. I mean, I think we're going to be 25s. I'll quote Sam Rines from Gorbu. It's 25s for life.
Higher for longer is
higher for longer. He didn't say much about the banking. I mean, it's in here. Just mentions. I think I came away a little dissatisfied about comments about the banking. Your thoughts?
What was interesting is that, yeah, you're right. Fed Chair Powell didn't say a lot about banking. Who did say something at the exact same time as Fed Chair Powell was in his statement was former Fed Chair Janet Yellen, now Treasury Secretary Janet Yellen, who basically came out about the banking system yesterday and said, we're not going to guarantee all deposits. And I think there was some hope already being priced into the market that they were going to do that. And so you saw small banks just get absolutely pummeled yesterday after Treasury Secretary Yellen said that. And I think that's really what added some fuel to the bearish move that happened at the close yesterday was, you combine the idea that, okay, the Fed statement is we're staying the course. We're going to raise rates. We're committed to battling inflation. We're going to closely monitor incoming information in regards to monetary policy, and that we do see need for firming. But today we're giving it all. The market's ignoring again.
Yeah, tonight the market's up, so everything must be good again. So we're back on the positive side. Yeah, it looks like we're about to cross some critical levels here on this. This is looking at the SPY. I just happened to notice this, but it looks like we're pretty darn close to getting the 5 and the 20-day exponential moving averages. We're a good day away from that happening. We've got the MACD crossing over, stochastics crossing over, the RSI about to cross over. So we're about to get another bullish signal. And I guess I haven't looked at the long term where we are in terms of the longer term moving averages. Have you looked at the 50?
Yeah, we're above the 50
and the 200,
and we're above the 200 as well. So I think, if you're looking at technicals, if you're looking at market momentum, it's hard to not be a bull right now. Sorry, we are not above the 50. We pushed above it yesterday, and then, it actually failed. Today,
right.
We've got to push back up above 400 on the SPY.
This crossover back here that happened in January is considered the golden cross. So the 50 crossing over the 200 is technically a very bullish signal. So that's a lot of technicians look at that level. And, we're near some very key levels of support here in terms of, this 4,000 level, which yesterday we broke above. And there's some interesting stuff when you dive into the depths on looking at the dealer gamma here. So we tend to be right now, like we're biased with positive gamma above these key levels and negative below, which means dampening volatility when the stock goes up and more acceleration when we're below. All right. Yeah. So the Fed, back to the Fed.
Do you believe what the headline says, Eric? The Federal Reserve now believes its work is nearly done. That's a headline on Yahoo Finance this morning.
That's Yahoo Finance. No, I don't believe that. I don't know. What did Wall Street say? That's yesterday's news. I don't believe that. I think the Fed is going to be data dependent. I think we're going to be doing 25s for life. The market, what does the market believe? So if we look at the dot plots, these aren't done every meeting, every other meeting. The FOMC members provide their forecast of where they think the Fed funds rate will be, and each one of these dots represents a person. There wasn't much of a change between the dot plots. So these are by Fed meeting for the year. By the year, so this is 2023. It looks like 2024 leveling off, and then these are the averages by year. So this is 2023 rolled up in 24. So the median averages do show us coming down. This is the Fed, but this purple line is where the market thinks we are, and you got to take that with a grain of salt. This comes from the CME Fed futures, and what's not shown in here is the error bars. We're looking at the center of what's the most probable number. There's actually a pretty wide spread. I'm trying to figure out a better way to graph this to show that there's a lot of uncertainty when you look at that the CME Fed Watch.
And in fairness, while you're looking that up, there's a lot of uncertainty even in the Federal Reserve dot plots themselves. I mean, that's a pretty wide range of expectations for different members of the Federal Reserve as to what their expectation is for future rates as well. And I think that goes back to your point of, I think they're trying to be data dependent right now and not forecast too far into the future, because we don't know. There's so many unknowns right now from the fallout of what they've had to do to try to control inflation. The speed that we've raised rates is unprecedented.
Yeah, they're just showing us that we get to sub 2%, in 2024. It's like almost priced in uncertainty, but we've seen these numbers move quite dramatically, and you got to take all of these with a grain of salt. And by the way, nobody here should be hoping for a rate cut. When a rate cut happens, that's when you want to have your hedges in place before that happens, because historically, when the Fed is cutting rates, the market crashes. At least that's what the data show. We'll look at that as we get closer to it, but everybody wanting a rate cut. I mean, let's just pause, which will be fine, and let's hang out there for a while and see how things settled out. Nobody knows what's going to happen next meeting, so when is the next meeting? is May 3rd. So, and right
I
now the
don't think
probability is this is going to change dramatically. If you look at these numbers, they're all over the map. So we'll see what changes between now and then. But inflation is still hot, depending on which metrics you look at. But
well, so I got to throw in a point here before you go away from that comment, because you're right. And the risk we run in people wanting a Fed rate cut right now is that they'll break something else, or the only reason they would be cutting is if something else is breaking really, really badly.
like
I
what?
don't, but well, there's a lot of potential things. Commercial real estate is a big one. But before we go to commercial real estate, because I actually think this is probably the next canary we have to watch. But back to your point about inflation, that's the risk right now. If they have to cut rates to fix something that they're breaking, they don't have inflation under control.
Right.
There's this guy I follow on Twitter. I think his name is Car Dealership Guy.
What? Okay.
I started following him because someone else, yeah, it's at Guy Dealership is his Twitter handle. It's Car Dealership Guy. And he's an anonymous CEO of a car company. And he just throws facts out about, so yeah, there he is right there, Car Dealership Guy. He just throws facts out about the car industry, of what's going on in the vehicle industry. Scroll down to the one he did 22 hours ago, right there. Here's facts. New car prices are at record highs. Used car prices are 5% off of record highs. Affordability is at record lows. Inventory is lower than it's ever been. And we know that interest rates, yeah, I love it. What's next is we're gonna
ride that training wheel, get our training wheels out.
So again, this is just one portion of the economy, but in a way, it's a way to measure inflation. If you find people like this that can give you bits and pieces of what's going on in the economy. We've actually, not to jump forward, I'm bouncing all over the place. We've got hopefully someone coming on to do a recording with us here, who's a specialist in the part of the economy that we're gonna do a recording next week, maybe.
Yeah, we've been talking about having guests on, and we're very fortunate in our line of business that we get to meet some really, really smart people and have conversations that just, I had a conversation with this guy yesterday that we're going to have on next week to talk about semiconductors. And he's a domain expert. I mean, just the history and the knowledge that he has and the insight. I mean, we talked for over an hour, and I was like, man, we just need to hit the record button. And I think we're going to do that next week. So we're going to have a real long conversation with this. But I think the key, takeaway is that those of you that are interested in learning more about semiconductors, and I'll just cut to the chase. The good news is there's some really exciting stuff coming down the pipeline, as far as semiconductors go. Of course, all of this happens in a bigger environment with other things going on. We've got Fed trying to get inflation under control. As you said, we got Chair Yellen talking in Congress that, we're not going to backstop everybody, which, is not a terrible surprise. And then we've got this multi-trillion-dollar commercial real estate issue that's about to rear its ugly head as well. You shared something from Danielle DiMartino Booth.
Yeah. So on that note, the risk is, and going back to what you just said about Chair Yellen yesterday, when she said she's not going to backstop small banks. I mean, the small to medium-sized banks got clobbered yesterday. And what's interesting about small banks is the small banks is where most of the commercial real estate market exists. Most of the loans that are done at commercial real estate are done at the small to community-sized banks. And we're going to end up in a situation potentially that causes, if we don't keep these small banks afloat, if we go down the path of this massive outflow of deposits that's happening. I saw a number yesterday, $1.7 trillion has already come out of those small banks just in the last 2 weeks since this Silicon Valley Bank issue. It's already flowed out. The speed, I think it was Bianco who actually tweeted that yesterday. And the speed at which deposits are leaving these small banks is frightening. And if they get to a point where they don't have enough deposits to maintain their mode of business, they have to start selling assets. And some of their key assets, as we know, have either been US Treasuries, and that's the issue that we all saw raise its head with Silicon Valley Bank. Another one is mortgage-backed securities, specifically in the commercial real estate realm. And this is a big deal, that if they have to start marketing these assets, it could really have an impact. Again, there's some of the sizes, the aggregate loss right now, the mark-to-market statistics by size. These are huge. That could, again, put further pressure on banks and potentially upset the commercial real estate market. So I don't know. I'm definitely keeping an eye on this. I know there's a lot of people talking about this. You shared a warning. Maybe you already brought it up on the screen. You're showing Danielle DiMartino's booth as well right now. The warning from JP Morgan, who said a similar issue right now.
Yeah, this came from John Sylvia. He forwarded this to me yesterday. This is from Bloomberg, that JP Morgan Asset Management chief warns on commercial real estate. And this quote down here, which really got attention for me, is that when the Federal Reserve hits the brakes, something's going to go through the windshield. This is George Gatch, who manages real estate money. So yeah, this commercial real estate thing, which, I mean, this whole thing, with work from home, it's one of the areas that really scares me, and I don't understand why it's doing so well, why it isn't already, but the warning signs are there. So for those of you that are trading REITs, maybe there's probably opportunity in here someplace. So it's something to keep an eye on.
I can tell you the reason, in my opinion, I believe the reason why the markets have still felt the liberty to ignore the Fed and to ignore these is there's still so much liquidity in the market. The Fed is trying to pull this liquidity out in a lot of different ways, through tightening, through their quantitative moves that they've been doing. But there's still so much excess liquidity out there in the market. I mean, you just look at the reverse repo rates and the activity that's going on at the Federal Reserve level. There's still like $2.4, $2.2 trillion every day going into the reverse repo market. And I know this gets wonky. We've talked about this on this program before, several months ago, but that is a measurement of liquidity still in the market. There's just cash sitting around trying to find yield, and it doesn't want to chase bonds right now, because who knows if the Fed's going to keep tightening longer for, higher for longer. This puts pressure on bonds. Bonds are not a good investment right now. So I don't know.
We got to hit a bottom someplace.
Eventually we will hit a bottom. I am optimistic about, you mentioned semis. There's some decent price action in the semis today. You look at NVIDIA up 3% today. Micron up 4.5% today. So some of the semi names are showing some decent activity. I actually have a handful of stocks that I'm optimistic of looking to get into as soon as we can find some stability. I just don't know that we found the stability yet.
Yeah. So next week we'll do this deeper dive and talk about some opportunities in some specific names. I think people will find that really exciting. I did want to circle back around to one other thing that I shared last week or earlier this week. And that was this tweet that I picked up. This came from Bloomberg. This goes back to forecasting Fed funds rates. So these are all the different forecasts. These dotted lines are the different forecasts. So we spend a lot of time talking about it. I'll tell you what my key takeaway is. Looking at this line, is whatever the forecast is, it's probably wrong. The question is it going to be higher or lower? Like if you look at these dotted lines, we are notoriously horrible at being able to predict where that's the one thing you can count on, is that the forecast for the Fed's fund rate is wrong. The question is it too high or is it too low? That's what you need to be asking yourself. So right now, I tend to think I'm going with the over. I think the Fed funds rate will be over what the market is pricing. And I know that's not what people want to see. But I do think, like I said, the indications that, I don't want to be the Fed. I'm trying to thread the needle here because they got lots of crises they're trying to deal with here. But we said they'll tighten until something breaks. And some things have broken, but bank failures are not uncommon. We haven't had that many in terms of perspective. It's getting a lot of attention. But I think the Fed has the tools, and Treasury, they're going to step up and do what they need to do there. But anyways,
I'm gonna have to say I agree with you. Sometimes I like when we disagree, but because we get a good banter going back and forth. But I'm gonna have to say I agree with you on this one. I think the market is too optimistic on they think that the Fed is done.
Maybe the Fed knows that, because the market's up today is when they digested everything and thought about it. I mean, we get these fast reactions. By the way, there's automated trading that takes the statements and the words and parses them and automatically trades off of the bias. We've seen all kinds of weird examples of some anomalies happening in the market. One of my favorites is when Bill O'Reilly ended up getting fired from Fox News. There was all this negative press, and O'Reilly Auto Parts stock took a dive because just based on the bots, because there's negative talk about O'Reilly. So when people went back and looked at it, I said, wait a minute, this is an opportunity. O'Reilly Auto Parts shouldn't be going down because of Bill O'Reilly on Fox News. But so there is that automated sort of stuff. And so it calls for being patient and making sure that you got to look at the market on different time scales and trying to take a snapshot of what happened 2 minutes after an event. We see this after hours. A company announces earnings, big stock move up. Nike was a great example this week. Nike made a huge move up and then pulled right back down. And once people were able to actually read it. So calls for a little bit of patience and standing back and trying not to be greedy and controlling those emotions of fear and greed, Greg.
Stand caller. That's what I'm because I agree.
Yeah, exactly.
Well, all right. Looking forward to next week.
All right, everybody. Thanks. Hopefully this is helpful. We'll throw some more stuff in later. So thanks, everybody.
Thanks, everybody. See you.